Thank you for joining iMeet. When you hear the tone, you will be the 18th person to join the meeting. This meeting is now being recorded.
Hey, good afternoon, everybody. This is David Blake with Tuesday Tech Talk. And sorry I missed you last week. I was on vacation. I want to get back this week and just go over a little bit of what's going on with the market currently. And then we're also going to go over a section of the Market Edge website called the ETF Center that can help you to possibly build some portfolios in emerging markets and developed countries that I think will make it really easy for you. And we have a little bit of a system that you can certainly use to do this yourself. After that, I'm going to talk about 20 to 25 minutes, and then we'll open it up to you for any kind of questions you have to discuss individual stocks, maybe industries, targets, anything else that's on your mind. So let's jump right in as we missed last week and have a few things I want to touch base on with you. Okay, as far as the market letter goes, the market posture is still bullish. We made a higher low last week, which means the CTI, cycles A and B reset. So the CTI is plus 13. We're not having a very good year. Mainly because we thought that we'd have a period of weakness in January, February, so we were on the sidelines on that, and we missed out that early gain. But basically, as you can see over here, since about mid-February, the market really hasn't done much of anything. So right in this area, we made that thing on March 1st, and after that, it's just been kind of sideways and meandering over here, trying to find support at the 50-day moving average. And one of the reasons I think what we're doing right now is the geopolitical risks right now are probably as much as they've been in the last couple of years. So that's probably going to keep a top on the market at least until some of this starts to subside. But the momentum index is a positive +2. That was down a notch. I mean, that's neutral. Easy to see why with that. The sentiment index is also a neutral 0. Internal breadth is mixed. We had, the number of new 52-week highs versus new lows have been contracting. The AD line on the NYSE at least made a new high yesterday, which shows underlying accumulation in the broader market, and we'll look at that chart just a little bit. The strength indexes that also measure accumulation distribution are also mixed at this stage. Now, one of the things on the market letter that we have, since we're talking about ETFs, is I try to put in there what ETFs over the last 1 week are outperforming or underperforming. And last week, it was interesting, especially communications, REITs, utilities, especially natural resources, outperformed all other ETF categories last week. And they're actually probably the strongest ones this week also as we see some of these geopolitical risks start to hit the market. As far as what was weak in the categories last week, that's mainly the small caps and technologies. You could throw financials in there too. Over the last couple of weeks, they've been trending sideways to lower. Okay, here is the, before we get into the ETFs, I just mentioned that the AD line for NYSE made a new high on Friday. So this is made a new high yesterday. Yesterday's close. We had about 1,000 more advancing issues and declining issues. Now, this is generally looked at as a leading indicator, as telling you that and mom and pops don't move this line. This is telling you that institutions are underneath while this is going sideways. They are still accumulating stocks, so that's bullish. But just to step back a little bit on the Dow Jones, we can see a bit of a triangle forming while we're in this trading range, coming down. We're running this into resistance up here. Our pivot point for where the traders would begin to get long again on the Dow Jones industry was around 20,748. Right now we're at 20,562. As long as we stay above this, which means we're kind of we've actually fallen down briefly below the 50-day moving average in here today. So we want to watch that, but we're still in the range. And as long as we stay above this 20,412, we're still making, momentarily at least, making a higher low. We'll see if we can make a higher high in here. If we do break this this 20,412 area, which was the low from a week and a half ago, that could induce more selling because you'd be several percentage points away from the 50-day moving average, and you could see possibly a pullback down to this area where we were in a sideways motion again at the end of last year, and that would represent about a 38.2% retracement of this whole move from November up to the March 1st high. Before that, you come into play the 20,138. That's the 100-day moving average, which would also give you some support. So you have some pretty good areas. I don't think, worst case scenario, unless you have a bomb drop or something like that, I don't think you're going to see it drop down below probably about 20,000 on the Dow. As you can see down here also, these are flattening out. The different indicators are basically they're neutral. A little bit of a downward bias on this. Here's even stochastics around 45, 50. They're not even overbought or oversold at this station yet either. Here's the 52-week new highs versus new lows. Now, you're not like what you're getting over here leading up to a new high on March 1st, but it's at least starting to trend a little bit higher. You want to see this getting up around 150 or 200. This is in the Market at a Glance section on the home page of Market Edge. Here's the NASDAQ. It still looks the strongest of all the different indexes. We're at 5840 right now, which is, let's see, we're still right in this really narrow trading range. The pivot point on here is 5870, so we have fallen below the pivot point on this. Next support down here around the 50-day moving averages is going to be 5823, so we're about 15 points away from the NASDAQ testing the 50-day, which is the first time it's done that since back here, back in December of 2016. So you want to watch that. The low point here from about a week and a half ago, 2 weeks ago, around 57.50. That would be something to watch also. But I think we're probably going to find some support down at this area right here where we've been in this trading range. Now you did have the NASDAQ right here that was on the 30th of March. We actually made a new closing high there, and we talk about negative and positive divergence in the market letter and all in some of these webinars. You can see that this was negative divergence on the MACD. There's also a negative divergence going on with the 14-day RSI. In other words, when this was making a new high, this was not confirming the move by the NASDAQ. Even on the CCI, you had a lower high on that. So this was actually a non-confirmed move. You want to watch for that. If we had other indexes making new highs, I'd feel much better that we're going to break out to the upside. But that was a non-confirmed new high. Now here's also the NASDAQ advanced decline, which so far we're holding this area since mid-December, not really going much, which tells me and should tell you that even though the NASDAQ looks better and is moving higher, more so than the other indexes, I think it's up 9% for the year. It's about fewer and fewer stocks. This happened to us a year ago, December, when the FANG stocks were pushing the NASDAQ and S&P 500 into new territory, and everything else was falling down. That was the negative divergence that made us go to a sell back then, and of course when we had the big drops off in January and February. So there's something to keep an eye on this. Again, if this line breaks below this, that's going to be a negative. That means there's a lot more stocks being sold on the NASDAQ than buyers. And the 52-week highs, new 52-week lows has also been contracting, which we'd like to see that up around 150 or so. The 50-day RSI on the NASDAQ over here is, I'm sorry, the 50-day moving average, what I spoke about before, is coming into play. And again, the pivot point, we're below that right now, but we want to watch this, right around 58.23 area, which is if we break through that area, we may get a little bit more selling pressure coming into that area. All right, now two of the indexes you want to watch, especially when you're pulling back. In the last week and a half, we actually outperformed. Here we have the Russell 2000. It's a small caps, and you can see a little bit of a triangle forming here. Looks like if we go below 1360, would be a little bit of trouble. 1342 could send this thing down to 1295 or so. Even though the Dow is down 100 points, the Russell 2000, this is good news for us, is actually up today. It's up about, it's flat. It's up 31 cents. But that's something we want to keep an eye on. That's if we can get above 1377, which it almost did the other day. That would put the index back above the 50-day and the 100-day. Now, this green line that you see on here is the 100-day, and this thing has been hugging that for several weeks, and that's a positive. Even the indicators, although they're neutral, you can see them starting to punch up into the bullish ground occasionally here. And this last little pull off, you didn't even get down to the other levels of the 20 levels, so it wasn't oversold there. So if we can hold in here steady and get above this 1377, that would be a positive. It's about 10 points higher than where we are right now, and that would kick the Russell 2000 back above its 50-day and 100-day moving average. So keep your eye on that. We want to see if we're going to break out the new highs. You'd love to see the Russell 2000 be one of the main leaders on that. Now, transports, we talked about this a lot. We also would like to see more participation on this. And right now, that 100-day moving average is actually capping the Dow Jones Transportation Index. Unfortunately, we're having a rough day on this one today. We're at 9,062. So we're in the process of breaking this support line, right over here. We hopefully we'll bounce off of this thing again. The pivot line is 91.84, and we're at 90.65. So we've broken that pretty good. We don't want to see this thing break down below 9,000 again. As you saw it over here, it rolled over, and that was when this whole pullback here, when we were expecting the whole market to pull over. We did get about a 10-11% pullback in this Dow Jones Transports, and the Russell fell about 7%. But because of all the passive investments into the ETFs, especially the SPY, the QQQ, and the Diamond, the broader market was able to hold up despite this internal correction that the rest of the market was going. So it was bullish to see this thing start to outperform the Russell, the Dow Jones Transportation, but this needs to get above 92.45 or so to start having more of a bullish look. Even, the indicators are still neutral down here. They do have just a touch of an upward bias. So what does all this mean right now? Well, except for the geopolitical events, we're pretty much stuck in a trading range for the broader market. I think I'd like to believe that we're going to break out to the upside, but when you have these geopolitical risks, you can get some sharp moves in that thing. You have the VIX is at 1551 today. I said in the daily market commentary last night that yesterday reaching 14 was the highest it had been since the end of November. The last time we were at 15 was back. That was back in the 1st of November last year, right before the election started. So traders are a little bit worried. That's telling you that maybe we'll get a little bit more slide in here. Hopefully, like if we do get a pullback from the saber rattling that's going on, it might be short and quick, come down here about this area around the 8,900 and bounce right back up. But we'll have to see. That's a lot of times, as we said in last week's letter, that you'll get some negative or positive divergence in the different indicators that will give you a hint that we're probably going to break out to the upside or downside. Except for that NYSE AD line making a new high, I'm not seeing a lot of positive or negative divergence that's giving me a hint that of which way we're going to break. So I'm kind of on the sidelines with this also. And again, the geopolitical risks can always cause if they fall down 400 or 500 points, maybe we bounce right back. It's anybody's guess on that. All right, so we're going to move on to this ETF Center. But I think you've probably been reading a lot or listening on the TV about maybe time to invest overseas in the foreign markets. And first, let's talk about the reasons why you may want to move money there. It's easy to just say, let's go ahead and they look cheap. Our market looks a little expensive. And we do look expensive. But anyway, one of the reasons that you want to diversify overseas is over the last 10 years, the S&P 500 here in the United States has averaged about a 6.7% annual return. Now, the MSCI index of foreign markets over that same 10-year period has averaged a loss of about 1.6% a year. So you've been over there, you're losing money, left and right. Now, if you compare that to the last 40 years, that same index has averaged about a 7.2% return. So he's had this 10 years of underperformance, which, if you follow the laws of mean reversion, that's telling you that the foreign markets certainly are overdue to outperform again. And those numbers should kind of give you a little reason, okay, that some people say, well, they're not making any money. Again, the mean reversion should allow the foreign markets to outperform. We're also seeing much better economic data coming out of especially Germany and some of the European countries. They've had that zero and minus rates for so long that eventually something's going to kick in. Now, Sam Stovall, who's one of the chief investment officers at CIFRA, used to be with S&P 500 until they bought that section. But he notes that a decade of underperformance is an unusually long time to underperform. It says and that means that you can't exclude international stocks from your portfolio any longer. And he's a big believer also that it's time to start putting some money to work in those markets. In addition, because of the high, as our markets has started to take off here, foreign markets, especially in Europe right now, they're trading at about a 15% discount to U.S. equities. Another reason that we may want to put some money over there is because in foreign markets, when you have a rising U.S. dollar, and if our rates begin to move a little bit higher here, the stronger dollar makes it more expensive for multinationals to sell their goods overseas, and that means that especially Europeans and Asians will begin to buy their own goods more than American goods, and that should help their earnings also. So what we want to look at today is how can we take advantage of the markets overseas that are outperforming. Now, this first chart I have, or picture I have, is if you go into the Market Edge website and you click on ETF Center, this is the retail site. We've divided all the market basically into 21 different categories of ETFs. They range anywhere from different sectors to different investment styles such as growth, value, mid-cap, small cap, large cap. And also we have the international ex-Europe. We also have just Europe. As we have leveraged ETFs and everything else in here. The Market Edge for the pros has 47 different categories. It goes into fixed income and commodities and that type of thing. But for most of us have this one, I want to take a look at this. Now, if you go over, once you pull this up and go into all categories, over on the right-hand side, you can click on relative strength. If you click on that, it's going to sort these things by the strongest to the weakest. Okay, you'll see over here as of this morning, specialty utilities are the strongest group of stocks in the market again. The relative strength is 1.03. They're outperforming the S&P by 3%. Okay, now you have specialty technology, which actually was at about 105 a few weeks ago. It's strong, but a little bit starting to deteriorate. Here comes health and some large cap growth. But down here you'll see international ex-Europe is right at 101, and Europe is at 101. So they're just starting to outperform the S&P 500 now. So this isn't like something where, well, they've been talking about this for a month. I've already missed the move. No, this move is just starting to go. And with indexes and all, you usually don't have a move that's going to last. You're not looking for something that's going to last you 2 or 3 or 4 weeks. When we talk about investing overseas at this stage, this may be something you want to look at for the next several years. Okay. Let's look at the next one here. Once you've sorted these things by strongest to weakest, and since we're talking specifically today about looking at stocks overseas, you can go in here and you can click on the category. Well, let me go back. Click on this international ex-Europe, and you'll get this. You'll get here's the S&P 500. Here's a group of stocks of international stocks right here. So what you want to look at here is this will give you a list of what ETFs are the strongest out there, and not every country is going to be. You don't want one of my problems was just buying like the EEM for emerging markets or some of these. There are certain countries that will outperform some of the other ones. One of the ones I like right now is Mexico. It got beat up pretty badly here over the last couple of months, and we're starting to see a rebound in the peso and all. But you'll see over here where you have like ECH. So here's Chile, which is the strongest ETF country outside of Europe right now. Here's Mexico. Then you have India coming in here. Morgan Stanley's China fund. I know these are hard to read, but if you go into your site, you'll get this same thing today. Then you have Hong Kong, Indonesia, Japan's down here. Here's an emerging market fund. But you could build, what you can do with this is, let's just say we're going to go international. So what I want to try to do is develop maybe one portfolio, and I want to have 5 developed countries and 5 emerging markets. That's going to diversify me enough and take away some of the risk, where I'm going to capture the gains in the emerging markets and the developed markets. So I can pick 5 of these of the strongest ETFs countries in here. Right away, I would look at, probably in here we could buy Chile, ECH, we could buy EWW, Mexico. Okay, we have INP, which is India. Then we have CAF, which is China. Then you have a couple over here, Indonesia, Hong Kong. You don't want to buy, sometimes you can get like 5 Latin American funds over here, 5 Asian ETFs in a row. You want to diversify within that grouping also. So we have Mexico, Chile, India, China. Now we're going to go down here, get away from Asia, and we have BRK, which is one of the BRIC countries. That throws in Russia, and India's in there also, China. And that would give you a chance to have a pretty nice emerging market portfolio of your own. So what you want to do with these things is you'll keep these things in a small portfolio. When they get downgraded, I usually will wait for the weekly ETF to get downgraded to not just the daily, because it's going to the weekly will keep you in these things a little bit longer. And since we're thinking more long term on these, we're not looking for shorter term trades. If you wait for the weekly ETF to get downgraded, what you'll do is you'll sell that one, and then you come up here and you look to see what ETF is now outperforming the other one. So maybe in a month, Taiwan moves up here and Chile has dropped off. Okay, you drop off Chile and you add Taiwan or Singapore or whatever to that portfolio. And that way you'll keep a rotation of those. Another thing, if you'll notice on this thing, which you can't, almost every ETF in foreign countries, as far as the emerging and developed countries, are rated long by second opinion now. But what you want to do, if you have 50, if you have one of these that it's still long, but it falls out of the top 25, I probably will sell it then also, because I want to keep that rotation going where I'm in the strongest ETF countries going out there. All right, now if you would, with Mexico, if we clicked on the symbol over here, it'll take us to the second opinion. We actually went long on that on Mexico, somewhere right around 48, looks like. Okay, so it's 52 right now. You might have a little bit of a pullback now, but this will give you the recommendation. It's a buy. It gives you the comments. It's just like any other regular stock. It gives you support and resistance where a sell stop might be, and you'll get the report on what to do with each one of these ones you're going to add to your portfolio. Okay, now here's another example. If you go down to this, you'll see the first page we had about 25. Now, if Chile would fall down here to this area in here, even though it would be rated a long, again, I don't want to have a long that's underperforming the other ETFs. So again, once it falls out of your the top 50% or top 40%, you can replace it with another one that moves up. Okay, now to add to that portfolio, what I want to look at is I know that Europe's strong and it offers me a little bit, the foreign exposure, but it also is going to give me a little bit less risk to my portfolio. So we do the same thing. We go into all categories. We click on Europe, and it's going to give us a list of the different ETFs that make that up. So the strongest and weakest, you start out with Spain. Okay, now you have a Wisdom Tree Europe hedged equity fund. I'm glad that this came up. The reason for that, when you invest overseas, one of the risks is is you have a currency exchange risk. That means if you buy France or something, the euro is weaker than the dollar. When you exchange the fund and sell it over here, you're dealing in dollars, and you're gonna lose some of your money. You could lose up to 2 or 3% of your total return just on currency risk. So you may want to look at some of these hedged equity funds when you're going over to Europe too. So that would be one that you could add to this. Another one we have in here, we have EWQ, which is France. Here's FEZ. Someone asked a couple weeks ago what I would invest on if I was just going to buy one fund. This is a Euro stock fund that basically takes in the top 50 stocks. It's one of the outperformers, outperforming the rest of Europe. But you can go on down here a little bit more. Here's another one. It's a DFE, since you have a couple large countries over here. There's a DFE, which is a small cap dividend fund. Maybe you add that into your just to diversify. But I also don't want to stick just with Europe as far as my developed countries. Don't forget, you also have Japan. You have I wouldn't say China, but some of the other Asian countries. I'd still classify them as emergency. But I would probably go down here and pick up, go back to international ex-Europe, and go with maybe throw a Japan in here also. And that's going to give you 10 different stocks to make up a portfolio. I don't think you need any more than that. You get more than that, you're going to drive yourself nuts. And this should not be able to outperform, most of the EEMs or some of the EVA that are some of the different ETFs that are a broader category. And this way, you're mainly investing in the stronger ETFs in the stronger countries. You look down here, Italy is it's starting to pick up again, but you probably don't want to be investing right now in Norway or Italy quite yet. Here's Austria. These are still long, but they're underperforming, so you want to keep up in here like this: Spain, France, maybe Netherlands, Belgium, Switzerland. I'm surprised Germany's down here, but anyway, this would give you the list of stocks to make. So, let me see. Okay. So anyway, what we're going to do is we're going to open this up to questions that you might have about individual stocks or building these portfolios yourself. And one other thing I want to mention while you're asking questions. At the beginning of the webinar, I mentioned that REITs were one of the strongest sectors last week, and I did a few more screens this morning while I was looking for some ideas, and I came up. There were a lot of REITs that were being upgraded to buys today, and when we've talked about doing screens on the market earlier, I've told you to also, besides the top-looking stocks, kind of take a look down there to see if you see a bunch of stocks in one industry, like maybe the home builders or maybe all semiconductors. In this case, REITs. So I pulled up the XLRE, which is the real estate select sector. We looked at the other indexes going sideways and not doing much. This is a pretty good looking chart. You have a nice trend line moving up. It came down, tested that. REITs are higher today. XLRE, let me see. It is, last I looked, it was the only sector in the market that was up. Yeah, it's up 1/3 of a percentage point today. So up here around 32.15. So this is something that, while you're kind of watching this geopolitical stuff going on, you may want to start putting some money in these REITs. If you're an older guy, you can buy some of these things, pick up 4 or 5%. They've had their correction. This move higher is being confirmed by the indicators. So this is something good. Now, some of the REITs that came up this morning, I think you could look at. Again, I like the stocks that are making new highs, that are outperforming. Here's one called EGP, East Group Properties. It has about a 3.5% yield, breaking out to new highs. The move higher is confirmed by the indicators. EGP is that, and came up today. Here's one called EXR, Extra Space Storage. Just cleared all its moving averages. This move higher is being confirmed by the different indicators. This one's paying you about 4%. Another one you could look at here. It's going to breaks above this. So it's up today also. You could add this to some of your more conservative type investments. And here's one called UHT, Universal Health Realty Income Trust. This thing's breaking out to new highs, also confirmed by indicators. I'm not sure what that's another one that's paying about 4% up in here. So maybe with the geopolitical risks, you may not jump in today, but if you can pick these things up on a little bit of a pullback, I think you could add some of these into your portfolio. So they apparently, besides the international stocks, REITs and utilities seem to be coming back in favor. Perhaps that also may be pointing that rates may be stalled here for a little bit until we see what's going on with the broader market and Trump's policies. Okay, I see a couple questions coming in right now, so I'll go ahead and get to those. And I probably will have to share my screen here. Can you talk about investing in VIX, given its movement? How do you recommend doing it? Okay, there are. I wish I had the date. I think it's somewhere around last March. We talked about the VIX. About they have leveraged VIX and they have different ETFs that you can buy to go in this. Now we've already gone from 11 to 15. That's a decent move. We were up 9% yesterday and 8% today. But if you're going to have if the market would get a correction, you'll usually see the VIX get up to about 23. So you do have some more upside to go with that. If you will send me an email to the doc@marketedge.com, I'll give you some of the ETFs that you can buy to do the VIX. Now I know there's an awful lot of people that are are hedging themselves with the VIX. So they may be a little bit more expensive than they normally would be, but certainly that's a way to hedge your portfolio. Usually before the market starts pulling back a little bit than now. And so you've had about 20% or higher move in that in the VIX. So, but send me that email and I'll try to give you some ETFs that you can buy to invest in the VIX without having to try to play futures or anything like that. Okay, what is your outlook for FXE? Is the euro dollar at its lows? Let's see here. Let me see if I can. I can answer the chart right here. You have kind of a you put a bottom in on the euro back probably towards the beginning of the year. Now you've pulled back here recently around 102. I think 102 it'll bounce off of that, and you could probably move a little bit higher. I'm not sure what the dollar is going to do, although if they start to once again talk about raising rates over here, that'll cause the dollar to move up. But you're at a low, pretty close to a low with the euro. I don't think maybe it gets down to parity. I don't think it's going to go below that. So if you're at 101, 102 right now, that's I don't think you're going to get that much lower. Any other questions coming in? Okay, I'll say just to wrap things up, and I really appreciate you taking time out of your busy day to join me with this. I hope you got something out of it. When you have these geopolitical risks in the market, they don't necessarily have to disrupt our economy and all that kind of stuff unless the bombs start flying, and then everything's out the window. But I think the economy is still looks like it's going to expand. That means you can probably buy the market on any kind of pullback that we would get, whether it's momentarily. And what I've been watching with a lot of different stocks, I still think the small caps in here. If you watch the Russell 2000, the fact that the Dow's down 100 and the Russell's up 3.5 points, that's a hell of a positive divergence to me. And that tells me that I think that we're probably going to resolve all this matter once things settle down a little bit to the upside. That also goes in line with our CTI count resetting on the cycles last week, that we should go positive. So again, if you have any questions during the week, you can send them to the doc@marketedge.com. I hope you got something out of this, and I'll see you all next week.